Hello, and welcome to our first quarter 2016 strategy review. Our meeting was held at the end of December 2015, a year as we all experienced with a lot of ups and downs, but came out about the same and therefore reflected a lot of the things that we talked about all year. On my right attending the meeting is Len Skena, CFO and Vice President of the firm. On my left is Bob Toomey, also a Vice President and the Head of Research. Also at our meeting, although not here today, was Scott Schill, who basically operates as our legal counsel as well as being on the investment committee. Before I pass off the review to Len, I would like to cover something which I find most interesting, and I've been talking about it for the last few quarters, that we may very well be in the beginning rather than the end of a long-term bull market. This was supported by a graph which you can now look at on the screen, and this graph goes back all the way to 1900, and it shows very, very long cycles. Those cycles actually run to 1929 when we had a speculative blow-off, to 2000 when we also had a speculative blow-off, and the midpoint was also a speculative blow-off. What this chart shows, though, is we look at a very long view, is while the markets have rallied significantly since 2009, this would indicate if history can repeat itself, which frankly it tends to do in my experience, and I've been managing money for other people since that middle blow-off. I started in 1961. It would indicate that we could well see this bull market continue for not just a short period of time, but as you'll notice out to the right, it could be experienced all the way out to 2034, and based on this chart could have a total gain of over 500%. At any rate, with that as a backdrop, we look at the more current transaction, the more current positions, and therefore we'd like to share those reviews with you. So let me turn it over to Len, who will start off by talking about the Federal Reserve, which of course has been almost all of the news for the last quarter of 2015. Len?
Thank you, Stan. We've been telling you for quite some time that the interest rates have nowhere to go but up. And with short-term rates having been at zero for the last several years, that particular insight didn't require an enormous amount of high-powered intellect. But by the same token, the real question has been, are interest rates going to go up quickly, and when is it going to start? We now know the answer to the second question. The Fed in December raised interest rates on the short term. Their target went up by about 1/4 point. Fairly modest increase, but an increase nonetheless. The markets reacted to this first increase since the financial crisis by overreacting and then by overcompensating when the news finally settled in a little bit, and then kind of not really knowing what to do with it because they're trying to figure out where the Fed is going to go from here. We kind of feel where the Fed is going to go from here is to raise rates on a relatively slow basis. We don't think that the Fed wants to jeopardize the U.S. economy, and the U.S. economy right now is not showing any signs of overheating. We've got relatively low inflation, we've got a relatively modest growth rate of only about 2% in the U.S., and we think that the Fed is going to be very, very careful in what they do. With that, I'd like to turn it over to Bob to talk about the outlook for the economy.
Thanks, Len. So just to follow up on Len's comments, as he mentioned, yes, the Federal Reserve's decision here a couple of weeks ago was really a momentous decision because it's the first Fed funds rate hike in 7 years, and we had been in this zero interest rate environment for so long. I think what we're facing now for the U.S. economy is really, you've probably heard this term, the new normal. And I think we're kind of still in that environment here for at least a while. And that is an economy growing very moderately at around 2.5%. and with inflation, as Len mentioned, remaining very low. If we look at the recent economic data, that would, for the most part, support that outlook. Employment has been growing steadily, not at a breakneck pace, but very steadily. The consumer spending has been fairly steady in this 2.5% to 3% range. Inflation has remained low. The corporate sector spending has been lower than expected, and that did affect industrial stocks in 2015. The reason for that really was the strong dollar and the implosion in oil prices, which I think affected the entire industrial sector. But going forward, the housing sector remains strong. We think the underlying U.S. economy is reasonably healthy and will remain so. And we, as Len mentioned, we do not think the Fed is going to take actions that will jeopardize the recovery. We do see problems for emerging market economies, and we'll talk about that a little bit later. And overall, we do not see any significant imbalances in the U.S. economy that would presage a recession at this time. And with that, I'll turn it back to Len for a little discussion about international positioning.
Thank you, Bob. While the U.S. is raising rates, Europe and most of the rest of the world is lowering them. Europe currently is dealing with a series of challenges, some of them related to general economic cycles, some of them related to global events, and some of them related, frankly, to the unique fiscal and political structure of the Eurozone. But with all that, we see, while Europe is going through this period of struggle, an opportunity to buy into Europe at a very, very reduced value. And so looking at it as a prudent opportunity to get a good value, we are overweighting things a little bit to Europe right now. It's something that may not pay immediate dividends, but it's something that we see as being a good intermediate term strategy at this point. China, on the other hand, is going through a slowdown as well, and the real question now is it going to be a hard landing or a soft landing for China as they continue to try to rein in their economy and keep it from crashing? We don't really know a whole lot about how solid the situation in China is because we don't trust a whole lot of the information that's coming out of there. And with that, we're continuing to avoid China. With China struggling a little bit, it's seriously impacting the emerging market nations. We are continuing to avoid the emerging markets right now as well because they are much more dependent on China than even we are. And so for now, we are continuing to invest in a broad worldwide index that we usually use, the EAFE index, Europe, Australia, and the Far East, but we're focusing an additional amount on Europe. The other side of this whole thing is that we have pulled out of our investment in the high dividend fund internationally. Right now, we do not see that as being an opportunity. They're very heavily invested in some energy and oil companies that we do not want to get overweighted to, and so we have pulled back on that. With that, I'd like to turn it over to Bob to talk about the U.S. equity situation.
Thanks a lot, Len. So as I'm sure most of you are aware, the U.S. equity market was, as measured by the S&P 500, was essentially flat in 2015 after several years of very impressive growth. The reason for that was largely a number of factors that came together: the decline in oil prices that affected the industrial sector, concerns over what the Federal Reserve was going to do, also, as Len mentioned, concerns over what's happening with the Chinese economy, and also the strong dollar, which definitely affected earnings for multinational companies, particularly industrial companies. And all of these factors came together, I think, to weigh on the market in 2015. As we look forward into 2016, some of the factors that I think are important to keep in mind are the fact that while the Fed is in now what could be officially considered a rate rising mode, as Len mentioned, we think that the Fed rate increases will be very gradual, and I believe we may not see another rate increase for quite a number of months here for a variety of reasons. Also, I think with the anniversary of the decline in the precipitous decline in energy earnings in the oil sector and energy stocks, I think that the nominal growth in corporate earnings can improve as we move into the middle and latter part of the year. And I think that that will help support equities. Also, with continued low inflation and a very moderate path for the Federal Reserve, I think that should support valuations as well as we move through the middle and latter part of this year. So overall, I think that as we look into 2016, the chances are very good that while the volatility may continue, that we think the market will be up in 2016, again in the range of 5 to 10%. Just very briefly, I want to mention some of the key changes to our equity holdings as we move forward here in the first quarter. We did increase exposure to large growth, to mid caps, and to REITs. And we also maintain exposure to both the energy sector and to forest products as a way of presenting or holding a hedge on potential inflation within the portfolios. So with that wrap up on the equity markets, I want to turn it over to Len to talk a little bit about fixed income.
Thank you, Bob. As we've mentioned, we expect the Fed to raise rates in a very, very deliberate and slow manner. And with that, we have positioned our bond portfolio not to be necessarily in a rising rate environment so much as continue to be in a low rate environment. When the Fed does raise rates, they affect the short-term side, not necessarily the long-term side. The long-term side reacts to market forces and a little bit to what's going on with respect to interest rates elsewhere. But what's going to happen is, as we expect it, the Fed will push short-term rates up, long-term rates will stay roughly where they are now, maybe go up a little bit, but the curve overall will start to flatten. Instead of there being a large disparity between the long end and the short end, they're going to start to come closer to each other. And when that happens, we feel that the best way to position ourselves right now is to be on the long end to give you some additional income in the meantime, and on the short end to be able to benefit from those rising rates and turn those short-term securities over to higher-term securities as they end up maturing and expiring. So we have, to some extent, barbelled our overall bond portfolio, weighting things more towards the long and the short and a little bit less so towards the intermediate. With that, I'd like to turn it over to Stan for some closing comments.
Thanks, Len, and thanks, Bob. And thanks to all of you for tuning in to our strategy review. As you can see, we're looking forward to a good, positive 2016, and we hope all of you experience a good, happy 2016. And tune in next quarter.